So we are a country of savers, given our obsession for guaranteed return products and fixed return instruments. The scores of accounts at banks, post offices, and other small saving schemes are testament to the fondness of such products. And today on the ET Money Show, we will discuss about one such saving instrument, target maturity funds. And for that, let's bring on board Radhika Gupta, MD and CEO, Edelweiss AMC, to dissect and to tell you all that you need to know about target maturity funds. Good evening, Radhika. Welcome to the show. And this is going to be a target maturity fund masterclass with you. So the first question obviously will be that the AUM of target maturity funds have risen from 29,600 crores in October 2020 to almost 1,21,855 in October 2022. Looking at the yields on 10 years, GSEC has moved from 5.87% in November 2020 to 7.3% in 2022. This category is actually seeing some interest of investors. Do you think it's the volatility or the uncertain environment that's actually taking investor towards this category?
Hi, Kavita. Always a pleasure to be here. So I think, yes, target maturity funds were launched in December 2019 with Bharat Bond 1, which is the first in the category. And today at almost 1.3 lakh crores, it is the largest fixed income category outside of liquid and overnight funds, which is incredibly credible because actively managed fixed income funds in this period have actually seen outflows post IL&FS and some of the events that have followed. Now, you asked a question about has this happened because of high levels of rates, etc. I don't think so. I think, and we are about 53% of the category as Edelweiss mutual fund today, by far market leaders. We have seen interest rates at 7.5%, we've seen them at 6.5%, we've seen them at 7.5%. Again, I think the trend is structural. Target maturity funds are for the HNI investor the best FD replacement you can get. They are liquid, they are tax efficient at 10% taxation effectively because of indexation. We can talk about more about that. And finally, because of the target maturity structure, they offer predictable returns, which actively managed mutual funds didn't. So you have predictable returns in a liquid and tax efficient format. And year on year, I think we've seen in our own book, both corporates and individual investors have continued to add. And I would not be surprised if the asset class is a couple of lakh crores a few years later when you're having this conversation. So I think the trend is structural. Of course, debt will be a part of anybody's asset allocation, and higher rates means you can lock in at better rates. But I don't think it's about interest rate sensitivity.
All right, so let's deep dive into the structure of a target maturity fund. What's there in the offer when you talk about target maturity funds?
So if I had to simplify this, I think target maturity funds, when you buy a bond as an individual, say you bought an NHAI bond, you buy the bond and you hold it till maturity. And if you hold it till maturity, you will get the yield you were told at the start of the bond, regardless of whether interest rates move up and down, Ukraine happens, whatever happens, all macro things happen. And FD gives you the same experience, predictable return experience. For X many years, I get X%. A target maturity fund is a mutual fund that basically a passively managed mutual fund that buys and holds a collection of bonds. Which bonds depends on the kind of target maturity fund. Each target maturity fund comes with an index that tells you which kind of bonds it holds. But the idea is there is a defined maturity, and that is called the target maturity. It could be 2023, it could be 2025, it could be 2033, as in the case of the new issue that we are launching, or it could be 2037. But you buy and hold bonds till maturity and you don't actively trade those bonds. The universe of bonds of target maturity funds today is either GSEC, so lending to the government, state development loans, so lending to states, which is also sovereign equivalent because they are guaranteed by RBI, or lending to AAA PSUs, so really your Navratnas, Maharatnas, as in the case of Bharat Bond. So I think in doing this, the structure combines credit stability because of the kind of quality of borrowers and predictability of return.
All right, so this also answers my question where I wanted to ask you about high credit quality and also transparency in this kind of investment instrument that has to offer. How can an investor see the transparent aspect of this particular instrument?
So this is a passively managed instrument, which means that the portfolio has to be benchmarked to an index. The index providers are people like CRISIL and others, and the indices are published just like Nifty indices and mid cap indices, etc. And there are a certain set of names, usually 8 to 10 bonds in a particular index, and the target maturity fund can only hold that. So in that sense, unlike a lot of funds, you have complete transparency as to the rules governing your target maturity fund. If it is AAA PSU, it can only be AAA PSU. And if the index has that collection of bonds, then you have to mirror that index. So the structure and the regulatory framework brings a lot of transparency, which is, I think, something that has made people comfortable with.
Let's talk about volatility. Will the investor experience interim volatility and hence the interest rate risk that this instrument might have?
Yes, so this target maturity funds work for people who hold on till the targeted maturity. In the middle, you will experience interest rate volatility. If interest rates move up, bond prices do move down, you will see NAV fluctuation and vice versa. I always say don't invest in a target maturity fund like a liquid fund. And the good thing is you have target maturity funds from 2023 all the way till 2037 from people like us. Now, what you should do is take your goals. If you have a 3-year goal, invest in a target maturity fund with a 3-year maturity. If you have a 10-year goal, then please go out with a 10-year maturity. And if you have a 6-month goal, then pick something like 20 or 23. That way you mitigate interest rate risk. What you should definitely not do is you look at the yield curve and you say, the long bond has much higher yields than the 1-year bond. I'll invest in that because that will have more interest rate risk. So interest rate risk is there in the holding period, in the interim period, but holding period investors don't get that. And one of the things that I can tell you from our own experience of managing this is we have seen AUMs being extremely stable through interest rate regimes. Sometimes NAVs become negative, but customers also have it in their mind that, listen, I've invested till 2030, so I'm not going to take that out.
Now, since there is a period till which your money would be locked in, how can one plan such an investment instrument in their portfolio?
So firstly, there is no lock-in. Your money is liquid. Actually, these funds don't even have an exit flow. Now, if you redeem prematurely, you may not get that yield, but there is no lock-in. These are completely liquid instruments. So do realize that. The best way to do it is globally there is something called laddering. And laddering means that if I have 100 rupees, I define my 100 rupees into goals. 50 rupees I need in 5 years, 30 rupees I need in 10 years, 20 rupees I need in 15 years. And then I align those time horizons of those goals to my target maturity funds. That is the best way to plan your debt allocation using target maturity funds. So you could have a 5-year goal that means someone's education. You could have a 10-year goal that means a wedding. You could have a 15-year goal that's retirement. And you basically define and bucket your money and match it to the target maturity fund.
Let's talk about tax implication. What are the tax benefits that an investor can get?
So this has the same structure as debt mutual funds, which is indexation. Now, indexation, what does that mean? If my target maturity fund is yielding, say, 7%, the current rate of inflation you can assume as 5%. That first 5% you don't pay tax on. So the balance 2%, 7 minus 5, 2%, you pay 20% tax on, which is about 40 basis points. 40 basis points on 7%. That's less than a 10% rate of taxation. In comparison, if you had invested in an FD that had earned 7%, you would have been paying a marginal rate of tax that's in excess of 30%. So for the full tax-paying investor or the 20% tax-paying investor, this is far more tax efficient than a deposit. The math turns out to be 2% plus a traditional instrument.
Target maturity funds for senior citizens, Radhika?
Yes, in fact, I think the long-dated target maturity funds can be used very effectively for retirement planning. In the Bharat bond series, which viewers are familiar with, our most popular ones are the long-dated ones. The 10 years that we launched, 2030, 31, 32, and now 33 is opening tomorrow. We also did a 2037 product that is a 15-year product, given interest rates are high. So you can use this opportunity to plan and lock in rates at a pretty attractive level for 15 years. That works well for senior citizens looking for retirement planning.
Talking about the kind of options available now, looking at the kind of lock-in durations this fund has to offer, the longer the better. Is that how you will explain it? What kind of duration should one pick up?
I think it is totally dependent on your goals. As I said, as a manufacturer, we are out there to build as many maturities. Our commitment is to give you a full yield curve, and then you match it to your horizons. Obviously, today with elevated interest rates, if you ask us, I think the 5 to 10 year point on the curve offers some very exciting opportunities. But really, I think it is individual and goal specific. The only thing is, if you're investing long dated, it's great to lock in that money, but remember it is a long dated allocation.
Talking about the fourth series of Bharat Bond ETF that's launching tomorrow, give us the details, please.
Yeah, so both series, three series already done, 50,000 crores of Bharat Bond, and Bharat Bond 2033, which is a 10-year product, opens for subscription tomorrow. People keep asking me what's changed. The real answer is nothing has changed. It's the same product, AAA, PSU, target maturity structure, same indexation 2033. And I think the responses to all our past three launches have been fantastic. So the approach is why not try to fix something that's not broken. But it opens tomorrow.
So all the first-time investor who might want to buy this coming up tomorrow, what is the exact process? How do you go about it? You just have to get in touch with the broker and just buy this. It's like a normal purchase.
So there are two variants that always come up. Let me just explain that. There is an ETF that you can buy through your broker if you have a demat account. Also, for those who don't want to do this via a demat account, there is a fund of funds vehicle. It's just a mutual fund that invests in the ETF. So if you prefer that format, then you can talk to your mutual fund advisor. And of course, reach out to our team if there are any questions.
Alright, so these are the nitty-gritties of Target Maturity Fund with the fourth series of Bharat Bond ETF launching tomorrow. Thank you so much, Radhika, for being on the show and explaining all the details to our viewers.
Thank you.
With that, we'll take a small break, and once we are back, we are going to help you identify or recognize a true financial advisor or a finfluencer. If you have to follow one, what are the red flags that you should be keeping in mind after this break?